Good evening, this is Ken Long from Tortoise Capital with a review of the weekend trading report for February 6, 2016. Market remains in bearish volatile conditions. On an annual basis, using weekly RSI 14, we are at the lower end of neutral with a score of 39. Shorter term market condition, the 10-day NDX is at 12 out of 100, so we're deeply into oversold. Looking at the market mosaic, price with respect to the 200-day moving average is red bearish at minus 7.10%, so we're 5% deep into the bear. Slope of the 50 moving average got worse to red bearish at minus 0.90. ADX 30.2 is a strong trend downward. The risk index is the 30-period moving average of the VIX divided by the 10-period moving average. The threshold between risk on and risk off is 1.0. We are at 1.009. That's risk on, but just barely. When we take that score of 1.009 and compare it to the last 5,000 trading days, we find the average and standard deviation. That allows us to compute the risk Z, which comes at 0.03. Here you can see a 90-day histogram of that indicator. You can see we've come from a minus 2 sigma all the way up to just tipping into the positive. Ordinarily, this is a good sign for entering swing trades on the long side. Because we are in a bear market, however, I'm treating it as heightened opportunity for one-day dead cat bounces, so I'm not likely to hold overnight positions, but I am willing to take trades on the long side if we get favorable intraday conditions, but no overnight risk. You can see that we've had a series of successive lower lows. Each time we've gotten up to this point before the volatility spike occurred again, and so I'm going to be very prepared for exactly that kind of a move, which would lead to a further sell-off. You can see the blended monthly rebalancing. The ETF 13 is deeply into cash and defensive plays. ETF 22 and 32 are also in defensive plays as well. You can see the leaders as of prices as they closed on Friday. The theoretical exposure of ETF 2 remains at 0%. The model portfolio is at 70% with stops in place. A quick look at the ETF 13 and 32 portfolios just again reveals everything on cash positions except for a few defensive plays here in the ETF 32. ETF Max again dominated by defensive plays and investment income generating tools. See how the VIX has responded this week with a 10.57%. S&P 500. Just notice again that the extreme performance that comes from things that are at the extremes to begin with. So things like Coors Holding, Newmont Mining, Mattel, all having monster weeks, which have made their months, which have really made their 3 months. And so we're going to be interested in looking to see if there's additional follow through here, maybe with Exelon, and then the big losers for the week, highlighted in yellow in this case. These used to be very strong, but then had sharp pullbacks. So these become candidates for either continued failure or a rebound where you can buy a market leader after a significant sell-off. So these are daily trades that I'm talking about framing here because of the bear market, but I do like investigating the extreme tails of our database. This is the market health check. The vertical blue lines are 10, 20, and 30 days worth of look back. The horizontal purple lines are price targets. These are areas that used to be support are now resistance, and that's the ladder of price targets. On the way up, I'm looking for 195 here as a return to the Bollinger Band mean if we get any kind of support here at 187. And then all the way up to the previous swing high around 211, 212. Right now we're 10 and a little bit off that swing high. We're about 4% off the bottom here. Excuse me. This is the slope value of the 30-period regression line, you can see that it bottomed out at minus 0.75 over here. Has slightly improved based on this failure to fail further, but we have not had much follow through after this initial nice burst. The slope of the 30-period regression line is down. The slope of the 10 remains up, but it's testing its lower limits here at 187. 187 looks to me to be a pretty important 10-day low support level. If that fails, I think it comes down and tests 181 once more on that. What we thought looked like a bottoming tail shaping up is now back in play. The jaws of PPO are still open to the upside, but they're closing fast. So if this is going to move, it's back up. It's got to move here, I think, this week. Yeah, that's what it's looking like right now. Pretty vulnerable to the downside, becoming a critical state. If this is a support level and continuing, you have an opportunity to get in early. But again, with more than 10% off the swing high, we're deeply in the bear. This is a market in which it should be shortening up your holding and respecting your risk management. Everything on cash in the ETF2. The S&P at 46 is still better than the global at 42. The leaders in the U.S. are the large caps. Tech and mids are tied, and then the small caps coming in lowest. Two strongest sectors, U.S. large caps and tech. Weakest sectors, Latin America, emerging markets, are seeing a little bit here. I should say Asia less Japan might be sneaking in. World market model, gold, silver, treasuries, corporate bonds and real estate, the alternative asset classes doing well. China now back under the database average. Only Malaysia and Indonesia are well above average. Almost all the U.S. is now below average. Haven't seen that one for quite a long while. Utilities, that defensive play is a global phenomenon. ETF top 30 from the ETF2 model. You're seeing the same things as we did in the BMR, and that is the interest generators in the alternate asset classes like gold, real estate, silver. Inside the Dow 30, Verizon at the number one position. Walmart has made a nice rebound in the second position. Long-term strength in Procter & Gamble, McDonald's, Coke, GE, and Johnson & Johnson. At the bottom, the only thing in the red remaining, Apple, Cisco, Disney, Boeing, Morgan. Shifting to the daily report. See, volatility has rolled over a little bit, but again, it's postured for another sharp spike like this one that we just saw, where it had made a nice, or an increase in volatility, roll off, and then a second leg. I think we're postured right here that if we get some more volatility spikes, we see another big sell-off here. That could be 5 to 10% additional selling in the S&P. Handful of dojis, some channeling and overreactions available, some 5DDs, not surprising. Only one symbol test out well in the auto framer, that's Nike. Some good RSI2 washout type signals. A couple frog candidates better than 3.0 and 3M and Coca-Cola. In the Dow, or in the ETF 30s, nothing tests out on the auto framer. Got some 5DDs, and then we have some short signals from the overreaction after their dead cat bounces. And silver and materials are threatening. Not much in the auto framer, just Nike, but still a reasonable target. And in the regression line fractal frameworks, you can see the relative strength leaders down here on the second shelf in the red. This is how many ATRs they are above their own long-term RL270, which we treat as fair value. And then these in the green are the deep value plays. They are the most numbers of ATR below their own RL270. Some daily squeezes available. I'll be looking at Procter & Gamble and DuPont for sure. Failure to continue upwards here. We now have price in between the polynomial and straight line regression. There is some potential for the long side if that this can hold, as we've seen the slope of the 30 cross its own 10 period moving average at a deep distance from the long-term average. So the last time it did that, there was this nice move available, and so we're not ruling that out, but it's going to be necessary to see that start this week, I think. Just flipping through some charts for you to review. If you want to stop the tape, you can. Z-scores of the regression line slopes. The 30 we've seen has turned and hooked up. The 10 has pulled back. The 90 has dropped out of its normal channel. This is a bad sign for the market. Now we got this triple bottom being tested here. If this fails, really look out below. This is ugly. That is really ugly. I mentioned that does not look good. This tight correlation between all of the sectors and the S&P is an indication of just how pervasive the selling and the weakness has been globally. When everything converges that tight, that's a bad sign. All right, that's everything I want to cover. Let's go Broncos. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.